Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, April 16th, 2018. Quick look at the markets here. We'll just take a look at the 15, 60-minute charts, the intraday charts, since we don't really have a lot to cover. Not a lot of any significant developments on the longer term time frame. So, we continue pretty much with the same theme we ended the week with, where we seem to be at a pretty critical technical juncture in the market, especially on these near-term charts. The story is this, as I've said since early April. At least here on SPY, the near-term trend has been bullish. The simple definition of an uptrend is a security making higher lows and higher highs, and that's the case so far. You can see each of these successive peaks here, and so far a few down there indicate that that's the very near-term trend. So, and that's what with a lot of volatility, even if you're not, even if you're normally a swing trader that holds for weeks, sometimes months, you can, in this market, you can have gains that are comparable to those, at least, in the market over the last couple of years when we had that extreme low volatility. You're getting that in now just a matter of days instead of weeks or months with these rips and dips because they're very large compared to what we've seen, some of these swings that lasted for just a few days, going back for years now. So trade as you want. Now, if you're looking for the longer term picture, I know there's people out there managing, long term retirement funds, 401k funds, long term money, and this is just noise. And I can't, you can't squeeze water from a rock or blood from a stone. So to determine the near-term direction right now, as I've stated, most of the longest-term trend and all of the longest-term trend indicators are still bullish. We've had a couple intermediate-term trend indicators flip recently, but we're flirting with those levels now. So again, I didn't want to get off topic. Let's just look at the very near-term outlook here. This is a 60-minute chart, and there's a couple of contradicting technical signals. We had a divergent low back here recently, which really was the catalyst right here. You can see the bullish divergence. That was the catalyst for this rally that we've had now since the beginning of the month, with the prices moving higher. Something else I'll point out is you may have noticed this. There are times where the stock market wants to go up. And it's simple. It just means there's more buyers, willing buyers, than sellers in the market. In this case, I also think it has a lot to do with the extreme uh, bearish sentiment and extreme put call ratio and short interest, everything we just hit recently with the market volatility. That tends to put a floor under the market. You have a lot of shorts that have to squeeze. You have a lot of put buyers that have to be roasted. Um, that's just how it works. The majority of options, both puts and calls, expire worthless. So when you get a lopsided trade, everybody has calls or everybody has puts. That's going to put a ceiling or a floor in the market. So that's why I've had this near-term bias. And if you followed me for a while, I put a lot into divergences. So I've pointed out these negative divergences that we have here, and I'm still leaning towards the fact that they're not going to play out. Divergences are not the be-all, end-all. And although it is a big part of my trading, there are times where I'll look at other factors going on in the market. So I'm seeing a market that wants to go up right now, but there's a little work to be done. That work to be done, what I'd like to see is these divergences burned through. And what I mean by that is I want to see, again, we're on a 60-minute chart of the SPY. If I haven't covered that, guys, it's up here in the corner, the time frame and the ticker symbol, as well as in the watermark back here. So if we can burn through these divergences, that'll be very bullish. I also mentioned, the fake false breakdowns last week. This is SPY that I'm looking at here. And, I have to be honest with you, the uptrend isn't super well defined. I have one line here that captures pretty much all the reaction lows except this brief spike down through there. I'm referring to this candle right here. And then we snap back up. So that is one trend line. But I could also draw another trend line if you want to get very technical and capture all the reactions. You have this line here that starts off the early April lows, catches that next reaction low. So maybe the market comes all the way down here and it'll still be above trend. Because remember, until we take out this prior reaction low, we are in a very near term uptrend. And of course, I could even play around with this line a little bit more. I could go, come in here, catch that reaction low. So either way, that's what the SPY looks like. And I've noted down here, you can see these boxes that I put up. I use the PPO, and it works well on the MACD as well in a 60-minute time frame. I use that signal line as a trend indicator, the 9 EMA, which is the last of the two to cross. And I'm referring to crossing this dashed line, which is a zero line on the PPO. The MACD also has, a zero line like that. And you can see typically when the 9 EMA or signal lines above the zero line, the trend is bullish. You can look above on price. And when it's below, I didn't box it, but you can see down here anytime the box isn't there, that shows you the trend is bearish. So there's something else to look at. And then finally, as I often say, um, usually when you are just coming off a pretty clear and powerful, this is clean divergence. I had nice separation between the troughs in the PPO. By that I mean these lows. You had a clear low here, a clear low here. You had divergence on the RSI, and so that positive divergence is now playing out. And it can happen, but usually you don't see right on the heels of a clean divergent low, you usually don't see a divergent high that plays out. Usually you have to have a trend play out first and then put in a divergent high with more what I like to call clean separation. So you had a peak right here, maybe the PPO would have come down lower, come back up and made a higher peak. Again, a lot of this is subjective, but this is how I trade, and this is one reason I'm still, despite, you can make a case either way. If you said, Randy, make a video and make a bearish case to short this market now, I could do that. I could make a case, but factoring in everything, and like I've been saying, my convictions aren't super strong. I don't think it's time to load the boat, but I remain long. I've been long, for the last couple of weeks here, and continue to be long and look to see a little more upside. So let's move on. We'll look at the QQQ and we'll look at the futures on the SPY. Why don't we start there looking at the SPY futures? This is ES. These are the E-minis and the SPY. This gives you a little more insight to what the markets are doing, because you have the futures trade around the clock, and they gapped up last night. That's hard to see on this chart. You can see a little gap right here, and that was despite. Keep in mind, and this is what I'm saying. The market wants to go up. We had the airstrikes from the UK, France, and the US on Syria. That news broke, I think, after the market closed on Friday. Normally, in a few weeks ago, that would have knocked the snot out of the market. The markets were good news was bad news and bad news was bad news. Well, that's, obviously not good news. It's going to escalate tensions with Russia, everything else. But yet, here we are with the markets continuing to climb. Right now, it's not much. This is a gain. I don't know if you can make it out here. 0.57 on the futures. I'm looking at another monitor, and we're up 0.59 on the SPY. So, yeah, we're up about 0.6%. And yes, we're still in what I refer to as a precarious technical position. We have divergences. I could draw it out here, even steepening right there. There's the divergence I'm referring to on the SPY. But again, the trend is up. It is wedging, and these are one of my favorite patterns: bullish falling wedges and bearish rising wedges. So again, if I want to make the case to short the market, I could make that case, but that's not what I'm doing right now. I'm favoring that these divergences will be burned through. We already had a brief, you can see that fake down. I talked about fake downs last week. I was focusing on the Qs. There's a break below the wedge. We snap back up in it again on the SPY. And then this lower trend line, I can also draw, a couple different variations of it. So because of the whippy price action, there's not any one clear uptrend line, but you can see there. So take any of these, and in trading, if I'm long, for example, like now, I give the benefit of the doubt to the last of the two to break. Or if I was looking to short right now, I wouldn't short a break of this trend line. It's already been violated a couple times right here, right here. What I would do is give it the benefit of the doubt and use probably the lowest trend line, which is this one right there. So, and again, even if we get to that trend line, even if we broke below it, we're still, by the definition of a trend, these are the reaction lows. We're still, we'd have to take out this reaction low to call this current uptrend into question. So that's that for now. Looks like a market that, despite quite a bit of negative headlines and pessimism lately. The market just wants to continue to rise. And don't forget, from a fundamental perspective, guys, that we had, if I'm not mistaken, I'm going from memory. I believe in January it was announced the largest number of planned share buybacks in history ever. So, if these companies follow through on their share buybacks, and there's also a lot of, they also plan to announce, a lot of companies plan to increase their dividends this year as well. So, from a fundamental perspective, and you guys know me, this market, I know I believe it to be in the ninth inning. Maybe the top or the bottom of the eighth, who knows? But this, sooner or later, we're well past the average norm for a bull market, for the average, duration of economic expansion. But it may not be over yet. And again, at this point, I'm not even calling for new highs right now. I can see the possibility. I'm calling for about as much as a 5, almost a 6% upside in the markets is my at this point in time are my uppermost targets. But that can all change on a dime. If we come down here and smash through, again, now we're on NQ, the E-minis, the NASDAQ 100. This is a trend line I'm looking at now. There's a couple I can draw. As you can see, I have a couple on here. We have this trend line. There was that fake down I talked about last week. Fake down meaning false breakdown or whipsaw signal. We broke down. But if you use this trend line, you can see that the NQE minis, the NASDAQ 100 futures, have been back testing. They popped above it, but this is sloppy price action, breakdown, pop back above it, back testing from below. Therefore, I'm putting a little more stock into this trend line because it's clean. It captures, I'll show you 4 reaction lows, none of which have been violated. You had the low back here in early April, second reaction low, another reaction low the other day, and then this reaction low, we just hit it today and bounced. And again, like the SPY, we have potential. We have negative divergence, not even potential. It's confirmed. We have a lower low there. There was a peak in the PPO, another peak. It turned back down. So at that point, we had confirmed bearish divergence and a rising wedge. So we're walking to razor's edge here. This market could quickly, all of a sudden, maybe news driven, maybe just the algo trading programs, high frequency trading, they hit the sell button and this market drops down. And I don't see really a lot of significant support until if you're a NQ trader. And even if you're not, if you trade the Qs, you should track the NQE minis. I think it makes sense to track both of those. There's free charting platforms out there. Investing.com will give you free real-time futures charts, streaming. You can use that to keep an eye on it. 64.66, and this is these aren't the continuous contracts. These are the June contracts. This is what I'm trading right now. So they're up, what is it? NQ is up 0.49%, a half a percent. The Qs are up 0.51 as I talk. So positive today so far, but again, we're walking the razor's edge here. As of now, we're holding it up, and if we continue to rise, we have the potential to burn through these divergences. Trend is still intact. You can use that same trend indicator here, and I'm talking about the crossovers right here, and you can see how well that zero line works. I have a histogram here, so you don't really see the zero line. The zero line right here in the middle comes across. There's your zero line on the PPO, and you can see here that that zero line, not only does it do a pretty good job of signaling trend changes when we cross above or below it. Let me change the color on that real quick. Here it is. So you had a crossover, and you do get whipsaw signals. That's the nature of, especially when you're in a sideways trading zone. Or trading range. But you can also see there are instances where that zero line, once a trend has been established as bearish as it was here, it will act as resistance when tested from below. So you see it came up here, and it was rejected off the zero line, rejected again. So this trend indicator kept you bearish or short from this point all the way down to about right here when we had this bullish crossover down there. So, and I will say it's a little bit whippy lately, but we've crossed over here. We had a whipsaw signal right there, but it crossed back bullish and it remains bullish for right now. So I'm giving the benefit of the doubt to the bulls, but I'll tell you, if I didn't have a position right now, I wouldn't be taking one right now. That let me just say that I would sit out at this point because this wedge can break any minute now, and I'm tightening up stops on the index longs that I have. Um, but also, I'm allowing, giving a little bit of room for this, whipsaw signal stop clearing raids, maybe a brief intraday break below that line and a move back up. Um, but again, if we do break it and it's impulsive, we're probably going back down here. And to try to quantify it for you guys, let me do that real quick. That would actually help me as well to tell you from where we're at now, measure that down. That didn't work. One more time. I have to grab a trend line. And to use a measuring tool, this is interactive brokers charts, about a 3% drop right there if we do break that from where we're at right now. And if we go up, I don't have this chart marked up that well. I do have a few levels. There's about 4% upside to that target, and there it is, about 5.6% to my, what I would call at this point in time, my uppermost, most optimistic target, about 5.6% on the upside. So and that's another reason why I wouldn't establish a position here. Your RR, let's round that up, even though it's not all the way to 6. If that's 6% upside, but then I have, if I'm wrong, a 3% downside, that's less than a 2-to-1 RR, meaning you're risking, $2 of profit for $1 of loss, or 3% downside for 6% upside. That's just not a favorable RR in my opinion. So again, that's trying to just communicate my thoughts. If you're not in the market, just wait to see if this is resolved. If we can power on up through here, take out these divergences, that opens the door then, and at that point, you might want to trail a stop and target one of these upper levels here. Or if you want to break a short down, a short a breakdown, you can target that level. And of course, if we take that out, then we start taking a run at those previous lows right here from early April, and a little to the left of the chart, a little bit below that are those February lows as well. And those would be, obviously, that'd be pretty bearish if that was taken out. And to wrap this video up, I know the majority of you out there trade ETFs over futures. So here's that QQQ 60-minute chart. Here's a trend line that I'm watching. Here's the current uptrend. Again, you have this wedge type action. You do have divergence, not very steep, but it is there. You're making a slightly lower low or equal lows. Doesn't matter if it's an equal or a lower low, as long as it's not a higher I'm sorry, equal or lower high peaks on the indicators with prices making higher highs. So this is negative divergence, but again, we had a divergent low. Again, I need to update these notes. It's not pending a bullish crossover anymore. I was identifying that before it happened. So it is a confirmed, we did have a confirmed divergent low back here. And again, you can see that the trend is clearly up. This is a trend line I'm using right now, and you might want to replicate this on the chart. We have several reactions along here. We have the lows. We have another reaction. Almost touched it there. Kissed it here the other day. And you can see the divergent high. And I've also often said this, there's fewer things in trading that are more bullish than either a failed breakdown. We did have that last week on the 15-minute time frame. I had a slightly different trend line. It looked something like this. I think I had wrong tool. I'll get to the 15-minute chart in a second. So we did have that breakdown right there. It was a false breakdown so far. And so that was a little bit of a bear trap, probably sucked in some shorts last week on Friday. And they'll, if we can continue to push higher, we're not out of the woods yet. Now we're only up 0.32%. But if we can continue to push higher, they'll be squeezed out. And then most importantly, if we can push higher, we'll take out these divergences by moving above these previous highs. And you can see, at minimum, I think we'll head up here to 165.66. Possibly all the way. My uppermost target right now on QQQ would be up here around this level, or around 171 or so. It won't be a straight shot up there if we get there, but that's where I think we go. And of course, if we break this wedge, then there's not a whole lot of support to down here. Down to either of these two levels here, about 158.21 and 156.90. I don't know if you can make that out. That's a support zone right there. Okay, and to wrap it up, here's that 15-minute chart I was focused on last week. So you can see when you go down to different time frames, you you sometimes have different draws because the reactions you get different. The chart looks a little bit different on a 15-minute time frame than it does a 60. In essence, this is that same bearish rising wedge and the same negative divergence right there. Let me clear this off. I'm using a MACD on this one. Let me get rid of these stochastics here. Put this back up. Put a PPO down here if I have it up. No, I don't. Not on this chart. Either way, MACD will be very similar. It's a close cousin to the PPO, and you can see bullish divergence. This is a very short-term time frame for active traders. You can look for these divergent lows, and this one played out for a 4.6% rally off that divergent low. I didn't measure this one out, but it's so far played out for, well, I can measure it for you, tell you right now. If I grab this line here, from the lows. That's from the lows right there. That's what I was doing, grabbing the lows to the highs. So far, the rally was 6%, so not bad off this divergent low. And again, we have a divergent high. We had a breakdown. This is that false breakdown. The reason I say false breakdown, this is the measured wedge measurement. You take the widest part of the wedge right here, and you add that to where it breaks down. Some people add it to the top. I like to add that to the bottom. That's where bearish rising wedges usually measure out to, and that would come in right around this target here, this support level I have, 158.65. But so far we saw very little. We saw breakdown. We back tested the wedge from below, had a thrust down. I'm sure that fired a lot of bears up on Friday, but then so far you can see we've snapped back and recovered. So anybody that shorted that, either the breakdown, and you have to think like, market participants. If somebody shorted that, or they shorted the back test, especially when they saw, okay, we back test and we rolled over, the old, and I don't say the old me, but normally if I, had a bearish bias overall, if there weren't other factors right now in the market, I would have shorted this. I would have added on the back test, and or once I saw that we rolled over impulsively, that's textbook action, price action for a bearish rising wedge breakdown, a back test, and then an impulsive move down. But so far, that impulsive move was reversed, 100% and then some. Now, we're not out of the woods yet because we can come in for another back test here. But what I'm watching for, and I'll wrap this video real quickly. If we take out these highs, that's even more, that further strengthens the bullish case. It does it for a few reasons. We've successfully defended the zero line here. That 0.03 reading, that's actually the MACD line, not the signal line. So our signal line's right about on the give or take. And again, if a couple basis points doesn't make a big difference above or below. Point is, we've been above trend, at least on this 15-minute indicator since this point here. And that's it, guys. So, bullish. Keep it very simple and straightforward, maybe overly simplifying possibly, but look for a breakout above that previous reaction high. If you want to know where it is, you can also do this on your chart. I put a crosshair there. The high was 163.26. But if we take another thrust down, especially impulsively, and we cut out this low here from Friday, which was, to line that up and look at the box to the left, the low was 160.67. Then that's bearish, and that could open the door for another move down, and maybe this wedge breakdown does play out. So that's it. Hopefully, at least I'm giving you some levels to look at, and hopefully soon this will all be gone. I'd really like to see these divergences taken out, prices move up, and then kind of put all this can make a bullish case, can make a bearish case thing outside. I'll put that aside. I'd like to have a little bit more confidence here. But again, sometimes the biggest money is made when it's not so easy. There are times where it's very easy. We have clear bearish rising wedges. We had those leading into the January highs. We're tracking those on a daily basis. And the minute they broke QQQ, SPY, there were our big sell signals on the U.S. equity markets. That was an easy trade, at least in my opinion. Some of the bottoms here, even though I caught the last two bottoms, they weren't as easy because things look bad. But the point I'm trying to make is it's not always so easy. It's not black and white, and sometimes if you either got to go with your gut, make a sound case. If I can't make a case to be, long or short, I wouldn't be long right now. And like I said, since this market could turn on a dime, I'm not super heavy long. And I may add some long exposure if this whole potential bearish scenario here, this potential wedge breakdown and all that, if that is dissipated and we move up higher, then I think we have a good shot of making a run, like I said, another 3, 5, almost 6% higher. All right, guys, let's wrap it up here. We'll see what happens, and we'll go from there. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.